Hello, welcome to the Economic View. I'm joined by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Very good. What a week to catch up. It's been an extraordinary week in terms of what's happened on the markets and where we are. Let's just have a talk about that, and then let's talk about what investors should be thinking of in terms of the future.
Yeah, so let's sort of recoup on the week. From the macroeconomic perspective, let's look at the macro thematics, because I think that's probably the interesting part. So it was triggered by last Friday's night non-farm payroll. So US employment is clearly very important now, because if you have a look, not just at the non-farm payrolls and the fact they created 200,000 jobs, that wages number, so that average hourly earnings, was astounding. That's the best they've ever had. It's just shy of 3%. And as we've spoken about here in Australia, if wages are increasing, inflation is coming. And that's the interesting part of this, is that there's always been a caveat in the market that the dual mandate at the Fed, full employment and inflation, were not being met, because yes, employment's probably there, but inflation wasn't. And what we also know from the Fed, and they've been telling us for ages with the dot plots, is this year was going to be forecasted to have 3 rate rises. At least that's what the Fed's been telling us on an average basis. The market, however, has underpriced that and sort of slightly disbelieved it. They said, we definitely believe you won. Leading up to last Thursday, it was definite 1, with the probability of a second sitting about 70 to 72%. Post that data, it's gone to definite 2, with the probability of a third. It's now dropped back to 42%, but was as high as 62. So that's a big differential pricing. That, hang on a minute, inflation's now coming, and that caveat that they probably allowed the market to sort of push back on it has gone. And that's been part of this drive. You know, you saw bond yields move up. It means that the pricing around using interest into markets is also slightly different. So you've had to sort of rejig, and that's getting away from what we're talking about. But yeah, it was very interesting that macro thematics sort of did it. We got back to the good old bad days of good news was bad news, and we got to throw a tantrum again.
Yeah, we're heading into this period which is being called synchronized global growth. So essentially what that means is that things are going well. We're expecting to see economies grow, out of a flat period.
Yeah.
And that's good.
Yeah, and we are. And this is the thing. So last Friday's data is a good thing. It is a good thing. We are seeing that the biggest economy on the planet is growing. It's filtering through to its actual people. Consumption, therefore, will increase. All of that kind of overarching macroeconomic stuff and the thematics that that brings is a good thing. And we are now starting to see signs that Europe's starting to get it as well. And we know that China is sucking up that growth by their exports, and the fact that their GDP grew for the first time and stopped actually declining for the first time in 2.5, 3 years. So it's a good thing. I think we've spoken about this before many times. With what was really interesting about this week's volatility is that if you look at something like industrial metals, which normally reacts to these kinds of things quite dramatically to the downside, they saw it as a positive. Copper markets, aluminium markets, zinc markets, they all went up over the volatile period. They saw what happened on Friday as another positive to show signs that demand for those kind of products in the US in 2018 will continue. It also means, as I said, that the China story is still very much on the up. The European story, therefore, will also come through. So, yeah, it's very interesting. It has created a lot of talk for obvious reasons, but the underlying conclusion, growth is still there. Synchronized global growth is there. Yes, inflation is coming, but that's not a bad thing. And the other story about it is that we are starting to move into a new period of growth that we haven't seen probably in the post-GFC world.
Yeah, so investors should really be thinking along the lines, economies are growing strongly. That's going to add a lot of value into, certain stocks, not all stocks, but certainly stocks that are hinged to economic growth.
Yeah.
And that's a good thing.
Yeah, absolutely. And that's what we've been talking about. But even before what happened on sort of Thursday, Friday, us here in Australia, and then sort of Monday and Tuesday, is that we have been talking about that, is that the growth story is still the place. I mean, even with the US getting inflation towards 2%, that is normal inflation in the US. In fact, it's actually slightly lower than their trend. The rest of the world is still low. So Europe, here in Australia, even Asia, they've got low inflation environments. And in that world, you want exposure to growth. It's why 2017 was so positive on growth stocks. And that hasn't changed in 72 hours of trading. The growth story is still there. And that's why that part of your portfolio is still the place and the most lucrative looking part of your portfolio. And remember, you shouldn't be setting your portfolio up just in one area. It should be diversified. You should have hedging positions of, something different like physical commodities or, physical commodity providers, things like gold, etc., or cash, and having exposure to cash, because you've got to look forward to 12 months. We know that interest rates are going to rise. That's a given. We understand that. So therefore, you can be picking up, yield premium for risk-free inside that portfolio as well. So this is not a panic moment. This is just a reweighting. We are not looking at 2008 and 9 GFC macroeconomic crashes or 2011-12 geopolitical issues in Europe with, remember the pigs and that acronym and all that kind of periphery stuff. It's not that. That is not causing this. This is just a market pricing reweighting that created a bit of volatility, and the old adage of up the stairs, down the elevator, unfortunately played out, as it always does. But if you look over that medium term and over the longer term, market is still way up on where it was, 2 years, 3 years, 5 years ago.
Exactly. I mean, if you look at the charts going back to last year and the enormous growth experienced in the US and to a lesser extent in Australia, but definitely in the US.
Yeah, looking at the US, 5 years, 74% up, 2 years, 40% up, last year, 25% up. So the volatility and it didn't even correct. We didn't get 10%. We only got 8.5% in the US. Over from the top of the market in mid-Jan to where it finished on, Tuesday night, it's 8 and a bit percent. Here in Australia, we only did 5.5% from the top of our market in mid-Jan to where we finished the other day on Tuesday as well. So it's a pullback. It's not a correction. Definitely didn't even get near a bear market problem. So just look through it. It's a small term issue.
Yeah. So for investors, I'd say, and hopefully you'll agree with me, but investors really need to take a long-term position on this. They shouldn't panic into anything, and really it's a matter of looking at the opportunities arising from economic growth.
Yep.
And structuring your portfolio according to your risk profile, but really not taking any drastic steps as a result of these movements.
And I'd agree by saying, look at what's happened post the event. There has been picking up of buying, and as we always talk about, markets look on a 12-month view. So that if they are happy to buy through this volatility after what was quite an interesting trading period, then it shows you that they see this as an opportunity, and they have seen it as an opportunity. These are investors that are looking for 6 to 12 to 3 year periods. The big fund managers that are managing that idea are going, great, thanks very much, I'll pick that up, and are looking through the cycle and are looking through what is a very, very short, in fact, I'd even say intra-day or intra-week issue. You might get more volatility. You normally get natural declines. You should. It's a healthy thing to see markets just taking breathers. You just happen to have it happen very, very quickly this time around.
Thanks, Evan, for joining us.
Thanks, Tony.
Thanks for joining us on The Economic View.